Well, with a new Congress and administration now in place, many farmers are left wondering what impact any potential tax changes might have on their business and also on their livelihoods. Roger McEowen with the Washburn University School of Law joins us now with a bit of guidance in today's Rural Money segment. And Roger, as always, thanks for your time here this morning. So what have you heard about any possible decline in the estate tax exemption, and what, of course, would be the impact on our farmers and ranchers?
Well, good to be with you this morning, Janet. What I have heard is, and this was in candidate Biden's proposals on his website, and it looks like this is where the discussion is heading, is to take the current $11.7 million value of that unified credit exemption at the time of death or for making gifts and cave that down to somewhere between $3 and $5 million. And in terms of the impact on farms and ranches, it would dramatically increase the impact. USDA data currently indicates that all farmland value of all land classes averages about $3,160 per acre, and the nationwide average farm size is 445 acres. So your typical farming operation has land worth about $1.4 million. Then you add in farm machinery and equipment and grain inventory, the house, outbuildings, retirement savings, life insurance, other assets. You're easily in the $3 to $5 million category. So while now not too many farms and ranches worry about estate tax, a lot more would if that exemption goes down into that $3 to $5 million category.
And Roger, now currently heirs receive an income tax basis in inherited assets equal to their fair market value. Have you heard any changes on this basis issue?
Yeah, and that's a really scary one. That's kind of the monster in the room, because income tax basis is an issue that affects everybody, no matter the size of the estate. And farms and ranches have a lot of highly appreciated assets, or conversely, you get the same problem with assets that don't have any basis or very low basis in them. Land that's been held a long time, or machinery and equipment that's been depreciated out. Well, the thing is, under current law, the heirs can get a step up in that basis equal to fair market value at the date of death, and then if they sell it, they don't have to pay the capital gains tax. And so if that rule is changed so that you don't get the step-up basis, that's really devastating, particularly also if they change the rule when you trigger the gain to be at the time of death rather than when you sell it. That would be really, really tough for a lot of farm and ranch families.
So, Roger, it all comes down to what, if anything, should farm and ranch families actually be doing now to try to protect their operations and their legacies?
Well, certainly they should be talking to their professionals, their tax people, their estate planning people, their financial professionals, and raising that question, having their estates and their financial situation looked at to see if there's anything that can be done now in anticipation of these changes that might be coming. Some things we can work on right now, some things we just have to deal with when and if the rules change.
All right. Well, Roger, as always, thank you very much for your insight this morning. Roger McEowen, he's with the Washburn School of Law. You can go online to washburnlaw.edu/WALTR for additional insight.